Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello everyone, I'm Ed Gotham and welcome to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. This is a special episode with Trevor Neil, who gives us exclusive insight into a new tradable product he's developed with CMC Markets, the RRG UK Momentum Plus. Trevor is an ex-floor trader and hedge fund manager and also a director at RRG. And we talk about the product methodology, how it captures early stage positive momentum in UK stocks, and why you might be interested in a momentum strategy over an index play. As we're introducing a CFD product here, I have to give you a quick disclaimer, as CFDs are leveraged products, and with that there are some risks to be aware of. 76% of retail investor accounts lose money when spread betting or trading CFDs with this provider. You should consider whether you can afford to take the high risk of losing your money. Thanks very much, and I hope you enjoy the episode. Welcome to the podcast again, Trevor. It's been about 6 months or so since you were last on here. It continues to be quite a strange year as well. Everyone's stuck at home. How are you?
I'm fine. Stuck at home, but actually in some respects enjoying it.
Yeah. And we're here to talk about a new tradable product, a CFD portfolio you've launched with Julius de Campinar, called the RRG UK Momentum Plus, which is available exclusively on the CMC Markets trading platform. Last week, Hayden had a great discussion with Julius, who's the founder of RRG, about relative rotation graphs in particular, but this episode we're focusing more on deconstructing how that's applied to your new product, the RRG UK Momentum Plus. I thought to kick off, it'd be interesting just to get a quick overview for those that haven't listened to the previous episode about RRG and maybe the most popular use cases today.
Yes, Julius and I have worked together on this for I think it's about 30 years, but we're both directors of RRG Research. But Julius is the creative mind that created this way of doing analysis. And the route it took was that we created this visualization using this dynamic quadrant, very sort of memorable sort of look, and it was first offered to users of Bloomberg, Refinitiv, Icon as analytics for people who manage portfolios, professionals who manage portfolios, to analyze the portfolios and to look for early opportunities of securities which were perhaps not yet the strongest securities, but were coming up in the list of performance with positive momentum. It's a clever way, if I may say that, of seeing very complicated data, multiple charts, all in one chart, compared to each other, so the picture is very clear. So it started off as an analysis tool, but then we have developed it into a trading program, which is now being offered as the CMC Momentum Plus program. And here we analyze the message of it using a quantitative and score-based approach to choose securities, or it can be in the future other things that offer outperformance opportunities. And what we're looking for is not the things which are better than an index, so let's say the strongest stock in the FTSE, because that's a relatively easy thing to find and calculate. The thing is in that list of performance of securities in the list itself is dynamic, and the greatest opportunity is not buying the things which have already arrived at the top. It's participating in their journey to the top and maintaining your portfolio until they begin to slip, even while they're still in perhaps the top decile of performance. So in this way, you're getting the things which are moving up the list, maybe starting from a point of underperformance, but moving in a relative basis through the list up towards the top. Now, this is how you can get outperformance of the index. not by buying the things that have already arrived, but buying the things which are coming up and participating in that, and also leaving the things early that are waning in their relative performance. So that's the great unique selling point of this momentum-based approach. And so we've set some rules for that and scorings for it, and now we run portfolios. And here we have got a product, the first product, which is based on the FTSE 350, so a broadly based portfolio representing the UK market better, I would say, than the FTSE itself. And using this universe, we are concentrating on the 10 stocks which have the highest score according to our analysis of the momentum, relative momentum.
Sure. And so I was having a look at the actual strategy. You could say is a factor-based strategy based on momentum as the factor, and then it works across relative strength basically is the indicator for that momentum. Is that correct?
Yes, it's two. There's two indicators. There's the relative strength itself, and that's not to be confused with Wells Wilder's relative strength index, which is a momentum, which is an oscillator. This is something divided by something, so the relative performance.
Okay.
But what we add to that is not just the relative performance, but the momentum of the relative performance. We are both technical analysts, Julius and I, and one of the things we know is that momentum precedes price. So if a market is going up as it approaches a top, unless it's a V-shaped top, it will slow up before it turns down, and then when it turns down, it will speed up. But there's a slowing up and speeding up process, and so we're observing the increasing outperformance with positive momentum. That's very constructive, and that puts you in the leading quadrant on RRG. And then you might move into an area where you're still outperforming, but you're losing positive momentum.
Yeah.
A very interesting area is securities which are underperforming, but have got positive momentum. And these are the securities, as I was saying before, that are coming up the list and coming up the list faster. These are the next best things, if you like, the new things.
Okay. And so yes, it's a technical based strategy as well, rather than a fundamental based.
Absolutely, there's no fundamentals in it at all.
Interesting point. And just before we move on to, it'd be interesting to deconstruct the quadrants a little bit and how and why certain areas are important. Can we just get a quick overview of your experience in the markets? It doesn't have to take very long, but just so people know who you are. And as far as I remember, it's taken you all across the world. So we could be talking about it for quite a while, I suppose. But just a minute or so, just to.
I'll keep it brief.
Introduce you.
I've been around for a long time, so it could be long, but I'll keep it brief. I started in the industry when I was 18. My very first job was as a floor trader on the coffee exchange in London, working for Merrill Lynch. And then I stayed on the floor for the first years of my career. Then I came off the floor. I moved more into fund management. I was very interested in technical analysis. Actually, I can thank Merrill Lynch for that, because part of my induction course was with them. It was learning about technical analysis. At that time, technical analysis was changing, going onto computers from chart paper, graph paper, and I could see that one day people would be using computers to trade, and people thought that was a mad idea, but here we are. And I was very keen on systematic approach, so rule-based approach. And I worked for a bank at one stage, running a hedge fund there at the bank, using a quantitative approach, a trend following quantitative approach, technical approach. I left the bank, worked for Bloomberg for 4 years as head of technical analysis there, which was great fun, and I traveled the world. When I was working for Bloomberg, my region was Europe, Middle East, Africa, and Latin America. And I can tell you, nearly every week I went off on trips and sped around the world. I'd do South America in a week, for example, 5 cities, 1 city a day. And so I did that, and I then left Bloomberg to run another hedge fund, a new hedge fund, which was based in South Africa. I was based in South Africa, and the seed money came from a South African insurance company, and we based ourselves in Cape Town. I worked at that, and this was very successful. My family, however, were not happy about living in South Africa. I thought it was wonderful, but they didn't. So I sold out and returned to the UK. That was in 2006, which was probably, if you think about it, a very good time to sell out of a hedge fund. And then things, of course, happened after that, financial crisis. Started a new fund, which I still operate today. And I also teach technical analysis. So hopefully there, 2 minutes is
thank you very much.
years of history.
And just quickly, how long have you been working with Julius for?
Well, we've known each other, I think it is about 30 years, and we always joke that we met at Cambridge, and we did meet at Cambridge, actually at King's College, Cambridge, but neither of us went to Cambridge. we were attending a technical analysis conference that took place in the summer holidays, and so we had a week staying in those hallowed halls, and that's where we did meet, and we've been friends since then. And eventually I was instrumental in getting the RRG charts put onto Bloomberg and onto Icon as well for Reuters. So it became this business relationship, and we have this company together, the RRG Research BB.
Yeah, thanks, Trevor. Very rare we have someone with such a long and interesting career in the financial markets that's taking you so many places, and it's great to be working with you on this. And I wanted to roll back to the RRG now, the Momentum Plus. What's the objective of the RRG UK Momentum Plus?
Well, I've learned as a trader, you need to try and establish some edge in the market, and as technical analysts, we think of things in terms of probability, and if rising lows are continuing, we're going up. So we try and latch on to these sort of as reliable as possible patterns. But one of the things that you can rely on is that if you have something which is rising with increasing momentum, it's likely to go further. If something has been rising and it's losing momentum, so its rate of change of climb is declining, it's potentially a top. And this is really capitalizing on this, but also to do it over a mass of securities, so 350 securities. And this would be, I don't know how many charts it would be to compare every single security with every single security in the 350. It might be 50,000 charts, something like that. And it's clearly impossible to do. So what Julius had done when he developed this was develop a way of normalizing that message where you can compare one thing to another. So oranges with oranges, not apples to oranges. And this is the clever thing about the chart. Then we have subsequently gone on to become rule-based in the interpretation of the chart. So rather than just visually like chartists, we're setting rules for it. And this way we can become systematic, disciplined, backtest the message. And
it's trying, I'm right in saying it's trying to, which you sort of touched on earlier, it's trying to get the stocks that in that universe, which is FTSE 350, which is the FTSE 100 plus the FTSE 250, it's the ones that are showing early signs of positive momentum against other, so that you capture that potentially what was implied is like a trend that's going to happen from early signs of positive momentum coming through. Is that right?
Yes, trends in momentum.
Yeah.
So what it looks like is, and this is why I mentioned that it's rather striking, is it's a scattergram with 4 quadrants. And so going from left to right across the scattergram, left is your weakest securities relative to the index in the middle, which in this case is the FTSE 350. So all the securities on the left of that are weaker than the index itself, and the things to the right of it are strongest, and the thing that is furthest to the right is the strongest. But on its own, that's just a static list of strongest, weakest. It's not really studying what they're actually doing. And so we have then the vertical axis, which is the momentum of the relative strength. Higher is most positive momentum, lowest is a low positive momentum. This gives us 4 quadrants. Top right-hand quadrant is the quadrant where things which are outperforming with positive momentum. You call that good. Bottom right quadrant, so right means it's outperforming, but bottom means with low positive momentum. The securities which are in that quadrant are things which are outperforming but have got low positive momentum, likely to not outperform much longer, or indeed start to join the underperforming area. The bottom left-hand quadrant, as you probably work out for yourself, left-hand side and below the horizontal, that means that it's underperforming with poor positive momentum. This is where you don't want to be at all. And then bottom left, for many people with a more aggressive outlook on portfolio, is there. It's left. Top left is it's left, so it's underperforming, but it's top with positive momentum. So these can be the next big things. Now, what makes this clearer is, rather than a static dots across these 4 quadrants, is the dots have got tails, and we sample where was the security last week, the week before, the week before, and let's say 5 or so tails, and what you get is a rotation going on, and you can see things moving and how they're moving in rotation. So things which are moving northeast, so between 0 and 90 degrees on a compass, are increasing in relative performance and positive momentum. And so with the computer, we can study where they are, what their direction is, and also the difference between the samples. So is it speeding up? So we can weight all those, and that gives us our list.
Okay. And when we're talking about relative strength, just to confirm, just in my head, are we talking about against each other stock in that sort of universe, or is it against, and you've created a sort of a benchmark, or is it against like a FTSE 100? How are you comparing relative strength?
Well, the raw relative strength is the security divided by the benchmark. So in this case, it's the individual security. Let's say we're divided by the FTSE 350. So the higher that reading is, the stronger that is compared to it, or it could be negative, in which case the security was underperforming the average itself. And then we look at the momentum of that.
Yeah. Okay. Good. Which is this sort of implying the trend direction
is
of
getting more powerful.
Yeah.
Is asserting itself or waning.
Yes. Okay.
It is outperforming, but it's losing power.
Yeah. We've talked about, you capture it. So where exactly can you just, where's the early signs of a positive momentum move then? What direction's the tail in? Where are these constituents here? So this is the top right quadrant, because the basket has 10 constituents at any one time. How are you ranking those 10? Where are those? Because I assume there's might be quite a few in the top right segment.
Yes, but we take the top 10.
Okay, which is based on...
It's just the top 10. We look at the charts, the normal chart, the arithmetic chart, not the momentum chart, but just to look at it as well. But essentially, it is the top 10 securities according to the weighted criteria, which the scoring I've said, which is top. So they will be outperforming, and they have positive momentum. It's another way of saying the best.
Yeah. Okay.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions, along with any other feedback in the review section. Now, back to the show.
So why the FTSE 350? Do you like the potential of UK stocks? Is this...
Yes, as opposed to the FTSE 100, the FTSE 100 is a very narrow index. It's only got 100 stocks in it. It's also quite a skewed index, heavily weighted with banks and miners, and as you've got very little influence of technology and other things like that. So we wanted the broader index of the FTSE 350, but they're all well capitalized stocks, so they're not getting involved in anything which is not liquid. So they're all big stocks, but we've got there things which are not well represented in the FTSE, like technology, like property, like non-financials. So it's just that our biggest companies are oil companies and banks and mines, and they have not been particularly successful sectors in the market. But unfortunately, our index is weighted with them. Doesn't mean Britain is not doing very well, because a Kazakhstan mining company is not doing well, but it's a heavyweight in the index itself. So much fairer representation of UK PLC in the FTSE 350.
Yep.
And we've got a larger universe.
Brilliant. I just had a question pop in my head, rolling back to this. The strategy essentially is trying to find the stocks that are going from not very good momentum into positive momentum. So it's this sort of, it's trying to find the turn around points rather than investing in, long-term trending stocks. Is that correct, or have I got that wrong?
No, it's not correct, because the problem is the turning point is it can be wobbly.
Yeah.
Now, I'm not talking about, let's say, after March sell-offs where it's a V shape like that, but much more often this persistent trendiness of securities and the sector rotation is a long-term thing, and we need to see it pick up. And we don't want to participate too early in it, because things which have been outperforming start to get better can get worse again. But once in the quadrant, we see it moving through the top left-hand quadrant and by reading the tail, looking like it's going towards the top right-hand quadrant. And when at the point that we can be confident about that, and what gives us confidence is the angle and the height of it, that it's going to pass into that elite group on the top right-hand side. And that's how we catch it early. But you don't want to be too early, because things are out of fashion and they become less out of fashion, and then they go out of fashion again. But it's only when you notice that it's getting fashionable, more and more fashionable, and people are beginning to like it quite a lot, even though it's not yet outperforming. Okay. That's where we pick up the increase in momentum.
Yeah. Okay. That's interesting. And an important point is that the basket's obviously rebalanced quarterly.
Yes.
Was there a decision behind quarterly base rebalancing that sort of is in line with this the stocks that are showing positive momentum, like the holding periods, etc.? Like, how do they all come together to make that like the most relevant sort of thing to do?
Yes. Yes, there was a lot of thought went into that. We want to pick up a sort of persistent trend in this performance, and if you look at it in a lower time frame, you're getting much more into the wobble of it, closer to the day-to-day news that is affecting it, and this can make things which look good, but then the next day don't. But we want this smoothing effect of the longer time frame. And we don't. The thing that we're participating in is long-term persistence. It has long-term persistence in it, and you don't improve its message by being too active in it. You can degrade your performance by doing that. So keep the sampling low quarterly. There's no need, and we've demonstrated to our own satisfaction that actually it degrades the performance if you become too active in it.
And it sort of relates to my second question about this, which is holding periods. What sort of, obviously lots of traders got different styles and strategy and how they want to do things, but in your mind, what would be this? What are you sort of aiming for with this product?
As a CFD for the customer himself. Yeah. Well, he can think of it two different ways. First of all, closer to an investment. So if you, rather than buy the FTSE 350, why not buy the participants in the FTSE 350, a subset, which have got outperformance momentum in them. So the best of it, if you like. So you can think of it like that as another way of more attractively participating in the FTSE 350. But you can use the characteristic of it as well as a trading vehicle. And this momentum characteristic, if the FTSE 350 itself goes up, you could expect it to do better. But if it goes down, it will also be quite savagely hit, because it's high momentum stocks. Momentum is also the case, goes on the downside as well. Yeah. But it would be a very attractive instrument, I would say, for when you see bottoms after these, because it's the momentum stocks that will lift early from it. So you want to get the swing of those high beta securities, and so this would be so you could expect. I'm not promising, obviously, but you could expect outperformance generally over time, because you're participating in the high momentum participants in the 3 FTSE itself. At times of pullback in the market itself, you're going to be hurt and it will underperform at that point, but it will flick back very fast indeed, much faster than the FTSE 350 itself, because it's an average of many things. Yeah. And so you participate in the higher momentum ones quickly.
Brilliant. And why would someone be interested in a momentum strategy over just selecting some stocks from the FTSE 100 or the index? I mean, you sort of implied the index there. You're going to get bigger swings in the momentum strategy, so there's potentially better upside as well as potentially bigger downside when it swings down. But why would someone want a momentum strategy over other strategies, do you think?
Well, it's this, if you agree with the idea that an index is a large group of stocks, some are doing better than others, some have got more promise than others on a relative basis, so you clearly see which are the best ones, but are they really the best ones to buy? If you buy the things which have already become the best, you've lost the best bit of it. It was when they were becoming the best that you got the real outperformance, the real alpha outperformance generation of the index itself. So we've got this portfolio which is rotating its constituents to being those 10 stocks, which are showing in according to RRG, the best relative performance and positive momentum of relative performance. So that's what's unique about it. It is using that segment of the index itself. So you would hope that over time this will outperform, and it's been borne out so far with what has happened in real life.
Brilliant. And I just want to ask, what risks should people be aware of when trading RRG Momentum Plus? We mentioned obviously it can be volatile because they're momentum stocks, because they're high beta in both in a positive and negative manner when the benchmark is moving in one of those two directions. Any other things they should be aware of, and how they could potentially manage that risk when using the product?
Yes. I'm putting aside all the risks associated with CFDs for a moment. We understand that these are leverage instruments, and with all the pros and cons of leverage. But in the RRG momentum itself, the risk is, number one, that you should expect that it will underperform when the market itself is going down. However, you can go short, and so therefore it's a wonderful instrument if you want to leverage up slightly your position in say the FTSE 350. So that's one risk, but is also potentially an opportunity if you read it correctly. The other thing is that because of the quarterly rebalancing, this means that within a quarter we don't do anything unless there's a particular emergency, like a bankruptcy, let's say. But that means that we are taking a very slow view to the changes in it, and not everything is always stays at the top and stays outperforming with positive momentum, but generally we know it's true, and that this infrequent reading is actually a benefit rather than a risk. But occasionally it will happen that one of the stocks will change in nature. It was good, we loved it, and maybe something happens, loses a contract, or something like that. I don't know, that would change the very nature of the security within the quarter itself.
Brilliant, thank you. And I just wanted to for the end of this interview, just quickly talk about your opinion on the market now, and also the latest holdings in the basket. So in terms of latest holdings, can you give us an insight into what's there, and any insight on what?
Yes, I mean we've got our 10 stocks so far. If you go on to your website, the CMC.
We'll link to that in the podcast so people can demonstrate.
So we've got the listings there. We've got all the performance of each one. The 10 are First Group, Weir Group, One Savings Bank Financial, Airtel Africa, NatWest, another bank, Crest Nicholson, Virgin Money, another financial, Megit, TI Fluid Systems, and Syntema. Now, those are our 10 holdings currently, all of them on a 3-month basis doing extremely well. And if you look at the chart also, the outperforming as a group, the FTSE itself. But you can see that at the moment, we've got quite a heavy weighting in the banks there of the 10, the large number are banks. And so we're catching this swing from bounce back from the banks. And we caught this well. It's still going on and is not yet waning. And so this is why we've got this heavy commitment to that particular group. But it is a rotating thing. At some stage, it will have recovered, and they will start to go into the quadrant of decreasing momentum, although outperforming, and we'll start to decrease that holding and catch what's next. And who knows what it might be? It might be cruise lines, might be airlines, all these sort of things currently out of fashion, but great bounce back potential. But no point in saying they must bounce back, until they do.
Yeah.
And see it happening in the banks, and we hated banks for years and years. Now we don't hate banks, and now they're performing extremely well.
Yeah, very interesting to see that, because it's a similar story in the US stocks. Almost the value stocks, the banks, the financials, the oil producers, energy, etc., been having a great run.
Yes.
Recently. It's very interesting that it's picked up on the UK, which is obviously the financials of the UK have obviously they perform well as well. So
yes, I mean, old oil is we love it now, but we hated it for a long time.
Yeah.
It's quite interesting. I think if you look in the States, if you ask the man in the street, what stocks do you think you should own given the pandemic and what's going on right now? 2 they might have chosen would be Pfizer and Zoom. But those 2 stocks have had severe sell-offs because, they both did go up a lot, but they topped out in around about November last year. And the market is always ahead of thinking. Yes, they are beneficiaries of it, but basically it's all priced in, and there are better opportunities. And so you have to be careful, because it isn't always as it seems. But this is taking out that sort of prejudice of the fundamentals and just looking at what really is happening. And this is where you're likely to get into things that are not really fashionable yet.
And I just want to quickly ask, it's quite interesting to compare UK against US. Just wanted your opinion on, obviously the US markets outperformed for the last 20 years against other sort of world indices, such as even developed countries such as the UK, the FTSE, etc. Do you see signs of that changing in the years to come? I just wanted your opinion on it.
No, I don't think that there's any sort of mean reverting law about that it must change, go back. The US is still, I'm not an economist, so I'm the wrong person to ask about that. But the chart of the S&P is a chart which is still climbing. The FTSE chart is climbing, but it's it's still below its highs and still below substantial resistance. The worry is in the US is that it is overextended. It's vulnerable to one of these sudden sell-offs like we saw in March last year. Any moment this can happen, and it is very vulnerable to that. So great worry to me about that. The amount the S&P is above its 200-day moving average is at a kind of similar level as it has been each time we've had these sort of 5% drops that have suddenly, almost without warning, hit us.
Yeah.
And what makes it so vicious is the fact that it is without warning.
Yeah.
it is a surprise.
Yeah, these sort of things can happen in a day nowadays, it seems. The volatility is so high.
Yes, it is, and I'm worried, but it's markets climb on a wall of worry, don't they? And it is grinding higher.
Yeah.
But let's say, like many people, I sort of don't sleep well, even though I'm long.
A final question as well. I just wanted to see, is there any other ideas for new products in the works? Anything you can reveal now? That
Very much so, and we're hoping to bring out that this is the first of many products. So this concept of outperformance and momentum of outperformance is applicable across many different markets, obviously different indices, but also sectors, or sectors versus the S&P, for example, or in Europe. So we can bring that product out. We can look at global markets versus the MSCI, so which is the best stock markets in the world, so we can bring that out using the indexes to trade. Asset classes as well. So anything where this momentum message has a benefit. So a basket to represent something it doesn't have a benefit. But if you're looking at relative opportunities, which most of us are when we're investing, then it has a real input. And the big one would be foreign exchange. Foreign exchange itself is, if you take the dollar as the benchmark, we've got over on the right, we've got currencies like the New Zealand dollar and the Norwegian crown and so forth. And then we've got weak currencies over on the left-hand side. But which ones of those have got positive momentum in them, as well as outperformance? And so we can pick that up on RRG and also apply our rules to have a portfolio of currencies versus, for example, the dollar. So using the advantages of momentum plus for it. So we are hoping that we can bring out these products as quickly as possible now that the model is working. There's really, from Julius and my point of view, we've got loads ready for you.
Brilliant. Yeah, very, very interesting. It's especially the Forex one, considering we're getting some big moves nowadays because of the valuation of the dollar, whether or not it continues. Even if it doesn't, you're going to get some big swings, it seems, because it really is moving. And obviously, a lot of the pairs, the main pairs are the dollar pairs, aren't they? So really interesting.
But you do get persistence in, the top ones stay the top ones in terms of outperformance in a very, very multi-month basis, and the weak ones stay weak. The ruble, the Turkish lira, there's nothing new in that. They've been weak for a long period of time. They won't always be, and there will be bounce back potential in them. And it's New Zealand dollar and the Australian dollar and the Canadian dollar and the Swedish crown and the Norwegian crown. All of them have been over on the right hand side for a long period of time, but that's not a permanent thing.
Yeah.
And and also one compared to the other, which is the best. So we can manage that through the RRG graphs. Excellent.
Thanks very much, Trevor.
My pleasure. Thank you, Ed.
And you can search if you're interested in the RRG product. It's available on the CMC Markets trading platform. You can download the CMC Markets app, or you can go to their website. There's a page on RRG which you can navigate to from the main menu at cmcmarkets.com, and I'll go into detail on the basket, the methodology, everything Trevor's been talking about. Any updates that we to the basket or commentary from Trevor or Julius will be added to that page as well. So that's the sort of hub of information. So please do check it out if you're interested. And as Trevor said, we'll be looking to expand the products that we're offering very, very soon. So yeah, keep tuned. Thanks, Trevor. Have a great day.
Thank you very much. Yeah, have a good day. May the trend be with you.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.